Hey guys, welcome to the Passive Investing Made Simple Bootcamp. This month's topic, we're talking about how to vet passive real estate deals. Now, you are in the right place if you want to learn how to take your active income and savings and turn it into passive income and long-term wealth. You see, maybe you've tried to invest passively before, but you just couldn't quite get comfortable with the investment. Or maybe you invested in a deal before and you're like, oops, there's a piece of due diligence I missed here. Maybe I made a mistake. Or you are an investing pro in passive real estate and you just want to level up your game. If that's you, you're in the right place. Now, if this is the first time we're meeting, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. And I walk the talk. I not only have invested in active real estate, over $800 million worth, partnered in over 6,500 residential units, 15 express car washes, and 2,200 self-storage units. I've also done the active investing myself. I've flipped over 5 million in real estate and then scaled the passive real estate portfolio. And I get to work with you, the investor here, in my role of Director of Investor Education here at passiveinvesting.com. And then I'm also blessed to work one-on-one coaching some investors as the founder of Ash Wealth. Now, if you are interested in learning more about my passive real estate or active and passive real estate journey, I've documented that journey for you in my book, Money for Tomorrow, How to Build and Protect Generational Wealth, published with Bigger Pockets. You can get that on Bigger Pockets using this QR code. Now, the whole point of me scaling my real estate portfolio is to spend time with my family. That's what I want to do. So that picture you just saw there was me and my crazy crew on one of our adventures last summer in Glacier National Park. But that's the whole reason why I invest in real estate. It's not because I love real estate, I actually do, but it's because I love what real estate gives me, the result, which is I can actually create time leverage in my life to invest in such a way that I have enough income coming in through cash flow and appreciation and enough tax benefits to keep that income tax sheltered so I can do this. I can have 100% control and choice on how I spend my time, which is, I assume, probably one of the things that you are seeking for too. Maybe you're a high income earner in your day job. Maybe you're a tech worker, knowledge worker, you're a lawyer, engineer, something like that. Or maybe you own your own business and you want to figure out how to take some of your active investing chips off the table, your active income off the table, put it into investments that are going to help you create that choice of time and location, impact, freedom. And we can help you do that here at passiveinvesting.com, whether it's through our multifamily, car wash, self-storage, equity deals, or through our debt investments like our real estate debt fund. We can help you do that, scale both equity, cash flow, and those tax benefits so you can meet your goals and dreams. So join us at passiveinvestingwithwhitney.com. That is a unique subpage where you get not only to see our active deals at passiveinvesting.com, but also you can get to my calendar personally. That way we can hop on a call to discuss your investing goals and how we can help you achieve those here at passiveinvesting.com. Okay, so we're going to talk today about how to vet a deal, a passive real estate deal. And I was just at an investing conference this last week, primarily with limited partners, okay, passive investors like you. And the question came up in the crowd. Somebody says, why do I need to learn how to vet a deal anymore? Can't I just ask AI to do it for me? And it got me to thinking here. The answer to this, one would think, would be yes. My answer is no, because really, when we think about AI in doing due diligence, there are certain things that it can do right now. I'm recording this in May of 2025. 2 months from now, there can be a whole other generative AI out there that is like 100% perfect at math. Well, right now, that does not exist. So what is AI good for, and what does the human touch still need to be involved with? Well, AI can actually like read a document. It's a learning language module. Okay. So it can actually read something, summarize it, pull out some key points, and that's about it, right? I even asked AI if I were going to have you help me do some due diligence on a passive real estate investor, how could you help me? And it gave me a laundry list of all the things that it can't help me do, which is it can't help me vet the operator, the market. Okay. It can't help me review the legal structures. It can't even help me evaluate communication correctly. It might be able to crunch some numbers for me, but hey, oh, by the way, watch out. I hallucinate. That's what the AI told me. Okay, it says, sometimes I get things wrong. So that means us as a human, we still have to take a huge role in not only vetting the operator, the market, and the deal, but really just understanding how all these puzzle pieces fit together. That way, when we do get a tool that can help us end-to-end do due diligence, which may or may not be coming really soon, we are prepared. We stay in control. We stay in the knowledge seat. So if you're watching the video here, anything to do with language, AI could probably assist with like helping like pick out some pieces, okay? But if it's anything to do with numbers, you're best right now in May of 2025, still picking through all the numbers yourself, okay? And when it comes to understanding how that investment relates to your goals and risk and timeline, that is something that AI can't actually help you assess right now, but you need to stay in control of, okay? So if we are still going to be in control and in charge of doing all the due diligence of the deal, let's dive in today and put together some simple systems that are going to help us understand if a passive real estate deal we're looking at actually belongs in our portfolio, something that we should pursue. Okay. Now, remember, before you invest in any deal, you need to understand what your investment thesis is, meaning you have to understand your goals, your risk, your own timeline. Okay. Not only that, and it's not just that, we need to understand how diversification plays into this thesis. Okay. But understanding that, building out that thesis, which we did in previous boot camps, that's going to help put us in control for when we do see a deal. So that whole thesis becomes like the funnel, right? We're going to drop deals on the top of the funnel. And if it passes our goals, risk, and timeline, some initial underwriting criteria, then we're going to get into analysis. But if anything violates those earlier assumptions on our goals, risk, and timeline, our diversification strategy, our early assumptions, deals out, okay? That's how we're going to stay in control here. So let's just dive in a little bit further. Quick recap. When it comes to our investing goals, do you like real estate? Okay. If you don't like real estate, then don't, you're probably if you're here, you like passive real estate. You're intrigued by the idea. But if you don't believe in real estate as a vehicle, maybe you don't invest in something that you don't believe in or you don't understand. And then we have to ask ourselves, well, what do we need from our portfolio? Okay. Do you need capital preservation, cash flow, equity growth, diversification? Those four are probably the big things that everybody needs: capital preservation, cash flow, equity growth, and diversification. Then we get some of the kind of like the gas on the fire, the pass-through tax benefits, the use of leverage, inflation hedging. Those are kind of like the things that are going to help us go further faster. But the core four are going to be that capital preservation, cash flow, equity growth, and diversification. Then you have to understand your timeline. Where are you in your investing timeline? And the reason why this is important is, if you're in the accumulation phase, okay, maybe you got 20, 30 years for retirement, you could take on possibly, if it's in your investor DNA, might be able to take on a little bit more risk. And if the deal went sideways or south, you would have time to recover. Whereas if you're like right at the finish line, about ready to retire, that's probably not the time to take on a high risk deal because you have zero time to recover. So you have to understand not only what investment phase you're in or part of the timeline you're in right now, but also look forward 5 years and 10 years where you're heading to. That way you can start seeing what's coming on the horizon. And then understand your risk, okay? When we look at the capital stack, our lowest risk, lowest reward, I shouldn't say lowest value, but the lowest reward tends to be on the bottom. Okay. And then the higher risk, higher reward deals tend to be on the top, like our common equity deals. Um, okay. But you have to understand it's not just about the different layers of the capital stack as far as risk, but you have to understand what keeps you up at night. Okay. If you're going to be totally freaked out by reduced or paused distributions or suspended distributions, then do not, in this part of the market cycle, invest in the common equity or the upper tiers of the capital stack. You need to be in the lower tiers of the capital stack. You need to take on lower risk. Okay. If you can't stomach the business plan risk, okay, as markets adjust, stay in the lower tiers of the capital stack. Okay. There are some amazing investments there that can give equity-like returns over time. So no need to take that additional risk. But then also, I want you to write down some of those tangible risks that are unrelated to the market, like capital calls, loss of capital, or heaven forbid, some sort of fraud. Okay. We want to make sure I want you to understand what is all that risk that would keep you up at night. Write all that down. And it's not because we want you to be fearful. I want to take that list that makes you fearful, and we're going to carry that through into building your due diligence tools, because all of that fear right there, we need to have a question to address it. That way you can suss out deals. Right? Okay. So all of this to say is that pre-work, okay, is what's going to put you in control. And here's the thing. I have talked to a lot of investors, and they say the whole reason, Whitney, why I do not invest in passive real estate is because I have no control. Okay. They tell themselves that I'm just completely 100% out of control. Why would I invest there? I'm just going to stay in the market where I have control. And I think people confuse liquidity with control. Okay. So even with stock market investing, I would argue you still need to put together your investing thesis. Okay. That way you go into the right assets that meet your goals, your risk, and your timeline. Okay. So I just want to bust this myth right off the gate. The other kind of flip side to this, a lot of people think control is actually the absence of any risk. And that's simply not true. Control just means that you have more influence on the decision, but it is not the elimination of all risk. Okay, so what can you control when it comes to a passive real estate deal? Well, just all those things that we just said. Okay, your investment thesis, who you invest with, where you invest, not only market, but where in the capital stack. Okay, and what deal you go into. You have an immense amount of control and decision-making power that you do not have in other asset classes like paper assets, stocks, bonds, and mutual fund. All right, so if last month we were looking at how to vet the operator, okay, now we need to get into a screening process around the market and the deal. Okay, now the market, I don't call it vetting because the market is the market. Okay, but we want to kind of screen what markets are good for our portfolio. Okay, so, and you're going to do this kind of high level analysis, not only what we call the major metropolitan service area, the large city area, and then you're going to also do it in the submarket. So I live in Boulder, Colorado. That is a submarket of the Denver metropolitan service area. Okay, so I want to take a look at the overarching large area, the big dot on the map, and I want to make sure the population's growing, jobs are growing, jobs diversity is present, meaning I just, it's say like not all auto industry, and if the auto industry left, we're completely up a river. I want to make sure there's different industries present. Okay. I want to make sure incomes are growing in this particular market. I want to make sure the crime rate is stable or declining, meaning that the town is, or the city is putting in funding to reduce crime. I want to make sure poverty rates are stable and declining. I prefer to invest in a landlord-friendly state, especially if I'm doing some sort of residential passive deal, multifamily deal, something like that. I want to make sure that, at least that there are favorable business laws in place for me as a multifamily operator to do business. I don't want to be dictated on how I have to work with my tenants, but rather I want to make sure I can work with my tenants in the most appropriate way. I also want there to be favorable tax laws. Certain states don't have good tax laws. That taxes on any deal is one of the larger expenses. I'm going to make sure I'm in a state where that tax isn't a completely large, absurd line item on my profit and loss statement. And then even though I took a look at the market level, I wanted to make sure that on the submarket level that this deal is in, that the same things are true that they were at the at the major metropolitan service area, that the submarket area, also want to look at supply demand metrics. Is there overwhelming, like in the case of multifamily, is there a lot of multifamily coming online in the next couple 12 to 18 months? Or is the supply in pace with the demand, the population that's moving in? And not only supply demand metrics, but if there is an oversupply, how long will it take that supply to be absorbed? This applies to multifamily deals, it applies to self-storage deals, even express car washes. And then, if I'm investing in a more cash flowing business like self-storage or express car washes, I want to look at the location. So it's not just the major metropolitan service area and the submarket. I want to know what street corner I'm on and what's the traffic count that drives by there. Okay, I want to get really super granular, and I want to know who my competition is in that area as well. Okay, so all of this data should actually be in the packet, the offering memorandum that your operator is, giving to you whenever you're looking at a deal. All right. If it isn't, you should ask. Now, maybe you just got off the phone with an operator and they say, hey, we love investing in these 5 markets. You can go do a quick high-level analysis of those 5 markets and be like, ooh, I like these 3, but these 2 I'm not so sure about, or I need to ask more questions. Okay. Now, what a little trick, a little hack I like to use is when I talk to an operator, ask them for previous deal offering memorandums. Even though they're closed, there should be some recent research on those markets so you can get familiar with those markets that they like investing in. All right, now maybe you can't get previous offering memorandums from an operator for whatever reason. But where else can you find this information? Well, you can, when you look in data that the operator might be giving you, you want to make sure that they're pulling data from reputable sources like CoStar, Marcus and Millichap, CBRE, Crexi. You want to make sure that you yourself can actually go review these reports. A lot of these reports are free. Another little hack I like is looking at the U-Haul annual move report. Okay, that'll tell you where people are moving from and where they're moving to. Then you want to also take a look at some other sites like now it's called citydata.com or niche.com. Those are, they aggregate, they pull in data from the BLS, and they will like demographic statistics, stuff like that on both the federal level, state level, and local level. And they create heat maps. Now, niche.com, they grade theirs on A, B, and C. So kind of like a little, school grading system. Citydata.com, they'll actually do theirs on heat maps. So it can be like a great, way for you to get a good visual of what's happening in the area. But again, if you have any questions that are coming up in your market reviews, make sure to ask the operator, where did you get your data? Where did you pull it from? I want to fully understand why you think this is a great market. All right, now we're getting into the deal. Okay, so there are a lot of terms that we're going to go over today, and I am going to assume that you know them. Okay, but if you want to learn these terms in depth, you can find those on our youtube.com page. You just go to youtube.com/passive investing dot com. And that will, I have some quick little videos that go into a lot of these terms. But first thing that we're going to do is we're actually going to screen the deal. Okay, so we get an email from an operator, it lands in our inbox. I want to have a very quick process for me to kind of like dig in or dump the deal. Okay, so when I work with investors, I sometimes will ask them, what's your screening process? And they'll be like, hey, this is my screening process. I get an email in my inbox and I go, I immediately open, I go, what's the pref? What's the equity multiple in 5 years? When do my distributions start? Are they monthly? What can I expect for a monthly return? And have they ever lost money? For me, I pause because are these questions really screening a deal according to due diligence and tell me this deal is good? No, these are all centered around like, when does the LP get money? And it doesn't even protect them in any way. So what are some better screening questions that we can use? And that is, when that deal lands in your inbox, is it actually from an operator that you have vetted? Okay. If you haven't vetted that operator before, if you haven't been on the phone with them, okay, it's not to say that's not a good deal. Your first action is, if you like the deal, is to actually schedule time with them and have a conversation. Don't pass go. This is one of those like monopoly rule situations. You don't go around the board. You get on the phone and you vet them before you dig in the deal any further. Okay. Is this deal and actually an asset class that I understand? Is it something that you already have dug into, maybe you've invested in before and it's just a different market? Or have you invested in before in that market, but it's with a different operator? Okay, is it an asset class that you actually understand? If not, push pause, go do your research on the asset class. Okay, then you can go, okay, does this investment actually meet my goals, risk, and timeline? Okay, let's take goals and timeline first. Say like you're an investor, you're a cash flow investor, and that deal hits your inbox and it produces no cash flow for the first three to 5 years. Okay, if it doesn't meet your goals, move it out. Okay. If you are accumulation investor and you're actually looking for an equity deal and it's only a debt deal, okay, does it align with your goals? Maybe we have to dig further. But if you're a cash flow investor, say like in retirement, and it's a ground up construction deal, a total equity deal, okay, that probably is not aligned. All right. Then moving on, how does it hit the sleep well at night criteria? Okay. Does it have a red flag in there already that's going to like not allow you to sleep well at night? Okay. If it does, push pause. Okay. Maybe you can dig in further. Maybe there's a question that can be easily answered by the operator. But we want to make sure that it's not going to be at risk for paused distributions, interrupted business plans, capital calls, any sort of fraud. And then we want to make sure that it doesn't violate any of our 8 red flags. And we'll go over those here in a second. If it does violate any of this, okay, push pause, move that deal out of your inbox, do some additional research before you dig in further. If it meets all of your screening criteria, then block time. Go to your calendar and block out an hour or 2 to actually do your due diligence on the deal. The reason why we have a screening process is to save you time, headache, and heartache. All right. That screening process, the reason why you have it set up, it's supposed to be done in like, say, 5 to 10 minutes or less. Okay. But that is not due diligence. We still need to dig in deeper. Now, here is my kind of, for a multifamily deal, this is kind of my 10-minute screening process. I always ask myself, when a deal hits my inbox, have I vetted the operator before? If not, I move that deal to a different folder and I'll deal with it later. If I have, I'm going to, continue to ask these questions. Is it a asset class that I love and I know? For me, If it is, then I'm going to dig in deeper and I'm going to see if it's like meets my investing goals, which is a balance between cash flow and equity. Does it meet my investing timeline, which is about 5 to 7 years? Is it moderate in risk? Where is it located? For me, I love investing in the Southeast. I love investing in business plans that are core and core plus. I love investing in business plans that preserve my capital, create cash flow, create equity growth, give me diversification. Then if I can get it, the icing on top, the tax benefits. I want to make sure that there's no red flags. Okay, we'll touch on those here in a second. And I want to make sure that once it meets all of those, then I'm going to start digging in on whether they have a sensitivity analysis. Okay, and I want to know their distribution schedule. Okay, I'm not going super deep here. These are just quick little like hits. And if I can check all these boxes super fast, then I'm going to put time on my calendar. All right, now we're going to get into vetting the deal. And before we get too far down this rabbit hole, I promised you about the 8 red flags. Okay, so we want to make sure that we are investing with an operator that has a minimum of 2 managing partners, ideally unrelated. Why is that? It's because if we have 2 managing partners that aren't related, the chances of nefarious activity go way down. Meaning if you just invest in a deal that has 1 managing partner, when everything is going well, awesome, thumbs up. But when it's not going well, it's super easy for one person to kind of cook the books, okay? Whereas if you got 2 managing partners, hopefully somebody like holds the other person's feet to the fire and says, whatever you're about to do is not a good idea. This is also why we want to make sure that they're unrelated to each other, because then their life circumstances are tethered out from each other. I want to make sure that they're investing in real estate full time, that this is their job. This is what they do. I don't want them 3/4 of the time on their own job and only 25% of the time building, wealth with my money in an equity asset. I want that full-time focus there. And there's a ton of other things, but those are some big ones. I want to make sure they're using leverage wisely. I want to make sure that they're not putting a refinance into a deal. I want to make sure that if they do have an adjustable rate mortgage on their deal, that there's extensions and rate caps, that they have it ironclad for at least the length of the business plan, if not longer. So I can also connect you to our managing partners article. Dan Hannaford wrote an amazing article, The 8 Red Flags of Real Estate. You guys should check that out. But let's get into the actual vetting part here, which is the framework. When we start vetting, when we have our big, long due diligence checklist, we're really trying to figure out 7 different things, the wealth pillars. How does this deal preserve capital? How does it create cash flow? How does it build equity for me? What kind of tax benefits are there? Is the leverage good on the deal? How does it hedge inflation? And who is that operator? Now, as I mentioned earlier, there's a lot of terms we're going to cruise through today. These terms listed here, you can go to the youtube.com/c/passive investing, spell out DOT.com, and you can get individual videos on all these terms. So number 1 is make sure that the deal actually is going to preserve your capital. Okay, so we want to invest in areas where the population's growing, the market's growing, income's growing, poverty's trending down, crime's trending down, tax and legal opportunities in our favor. But more importantly, we want to make sure we're not buying the best deal in the market. Okay, we don't want to be the top dog. We want to have some wiggle room between our asset and the top performer in the area. We also want to make sure that there's reserves in place, at least 6 to 12 months of operating reserves. Now we're recording this in May of 2025. I would argue that we want to see closer to 12 plus months of reserves on a property. And then the other question is, we want to know, where are those reserves invested, or if they are. We want to make sure that those reserves are liquid and ready to be used in order to stabilize that property. We want to make sure that there's a sales comp higher than the subject property. We already touched on that. We don't want to be the top dog in the market. And we want to make sure there's a clear business plan, and then maybe a contingency plan B and a plan C. We call those contingency plans. Number two, we want to make sure that we're vetting the deal for cash flow. Okay, so number one, according, we want to make sure our money isn't going to go anywhere, that it's preserved. Okay, so rule number one of investing by Warren Buffett, it says, don't lose money. Rule number two, see rule number one. Why is that rule number one? Is because even if you're in a deal, say for 5 to 7 years, and at the end of 5 to 7 years, you get your capital back, okay? One might say that deal was a loss, right? Because due to inflation, but you get a majority of your capital back, you didn't get knocked out of the game. Now, we all want to invest in deals where our capital is going to grow, okay? Totally get it. That is what I want to. But even if you get majority of your capital back, you don't get knocked out of the game. Now, guys, have I lost money in real estate? I have. It sucks, okay? And we want to make sure that we are not investing in losing deals. Okay, so rule number two, cash flow. This also combines with rule number one, which is vetting for capital preservation. Because if I invest in a deal and it already has cash flow on it today, even if it's super minimal, it tells me that it's already stabilized or close to stabilization. Okay, a little less risky. So then we want to make sure that there's a clear plan to grow the cash flow over time, either growing the cash flow through increasing income, decreasing expenses, or adding additional streams of income. More importantly, especially if it's a residential deal, like a multifamily property, we want to make sure that the operator underwrote the vacancy appropriately. Meaning they're not hoping that it's going to be 1% vacancy rate in their area. No, that it's actually market rate, if not double, okay, that they hedge some risk in there. Okay. In order to protect the cash flow, we want to make sure that there's reserves in place. We want to make sure that there's a low break-even occupancy. Even if the occupancy dropped on the project, that it only needs to have like 65% of its units filled in order to cover all of the expenses. All right, we want to make sure that the rental comp, if we don't want to be the top sales comp in the area, we also don't want to be the top rental comp. We want to have some wiggle room there for us to move and adjust our rents. And then cash flow, I also look for distribution timeline schedules from the operator, at least monthly, if not quarterly, because that gives me a key indication on how the operator is able to settle out their books on either a monthly or quarterly basis. All right, number three, vetting equity. All right, so we want to make sure that the business plan has a plan in order to decrease what we call the net operating income, okay, on a commercial project. Okay, we already pulled these levers for cash flow. This also helps us increase the value of the property, which is increase in income, decrease in expenses, adding additional streams of income to the project. All right. Now, here's the thing. Just because we pull those levers, we also have this mysterious number in the market called the cap rate. All right. We want to make sure that even if we increase the NOI, that the cap rate will still, when we take that NOI and we divide it by the market cap rate, say like 4% or 6%, that we're still going to be increasing the value of the property over the lifetime of the hold. The higher the cap rate number, the lower the potential valuation of the property. The lower the cap rate number, the higher potential valuation of the property. Okay, so we want to make sure that the operator is actually looking at what we call an reverted cap rate, meaning if they buy at a 5 cap, that they are underwriting that their cap rate is actually going to get worse and go up to say like 6%. Okay, and that the deal still works. We'll get more into sensitivity analysis here in a little bit. But also looking at equity, we want to make sure that we're taking a look at the waterfall, who gets paid what and when. We want to make sure that's aligned. We'll take a look at that here in a minute. And then we want to look at all the different fees. on the deal, okay? Because those are ways that money can get sucked out of the deal pro forma and leave less cash to distribute to the limited partners. And more importantly, are these fees warranted? Okay. We don't want to be in a deal that has a 5 to 10% construction fee. And guess what? There's no construction on the deal. That's not aligned. All right. Just a brief pause here, guys. I know we're going through a lot of information here. So I encourage you to rewatch this video a couple times in order to extract out everything in here. But more importantly, if you are interested in learning how we can help you meet your investing goals, jump on over to passiveinvestingwithwhitney.com and make sure you're on our passive investing club list. Okay, when it comes to equity, we need to get proficient at reading financials. Okay, so, and I want to kind of delineate for you, there are, when we read the financials, there are terms that are the actual returns, and then there are returns that are what we call investment hurdles. Okay, they're very different. And oftentimes when I'm talking to limited partners, they get these confused. So when we're talking about returns and you're looking at a deal, here are the terms that are actual projected returns on the deal. Cash on cash, internal rate of return, annualized rate of return, and equity multiple. That's telling you how much cash is coming in, or after the business plan, how much of a return that you can expect. Now, a lot of times when I talk to limited partners, the first question is, what is your preferred return? Here's the thing. A preferred return is not a return at all. That is an investment hurdle, meaning a preferred return is what that operator has to meet first in order to start splitting profits with the limited partner. Okay, so let's go through some of these really quick so you can see the math. So cash and cash return, in order to get at this, you're going to take your annual before tax cash flow and divide it by how much cash you have in the deal. So if you got $8,000 for 2024 on a $100,000 investment, your cash on cash return was 8%. Now, the internal rate of return is a little different. That is a calculus equation that takes into the account time. And so essentially, it's a rate of return that would take into account the present value of future cash flows plus the market valuation of an investment opportunity equated to the current market price of the opportunity. And then, anyways, long story short, the cool thing about an internal rate of return is you can look at two different deals with two different timelines, and this is the only number that you can compare between the two. So you might look at one multifamily deal with underwritten to 10 years that says it's a 18% 18% IRR, and another one that is a 5-year deal and it's, an 18% IRR, and they both have the same IRR. The 18% in 5 years is better because you're getting it quicker. All right. Now, the annualized rate of return can be calculated two different ways. It can be including disposition, what you make in the disposition. It can be excluding the disposition. Okay, so if I'm going to choose, I'm pretty much going to choose the IRR to take a look at. Now, equity multiple is a little more simple. Okay, so that is going to tell you when you're going to exit the property, how many multiples on your initial amount invested are you going to get? So if I invest $100,000 and in 5 years, I'm expected to make a 2x equity multiple, that means my $100,000 between cash flow and capital gains goes to $200,000, 2x, okay? Now here's the thing, 2x in 3 years is not the same as 2x in 5 years or 2x in 10 years, okay? So it doesn't, it's relative to the time horizon. All right, now we talked about preferred return, also known as the pref, okay? This essentially is where an investment hurdle, where the operator will give away a certain percentage of the investment upfront before they are going to start splitting the cash flow and the remaining equity or capital gain with the investor. So to date, on our multifamily deals, we've in our self-storage deals, we've generally done a 7% preferred return, meaning that we are going to give the limited partner 7% preferred return up front. And then after that, we're going to have some sort of waterfall to start splitting the rest of the cash flow and the capital gain. And it generally looks like this. So when you look at this on the left, this visual on the left-hand side of the screen, this doesn't tell you anything about the hurdles. It tells you about the percent ownership and the capital stack of that particular asset. So what you're actually looking for is this image on the right, which is the partnership structure. And so what you're looking for in an offering memorandum is for it to say 7% preferred return to an investor, or whatever that number is going to be. And then we're going to get into our waterfall split. So after the 7%, what happens to the cash flow? Okay, in this case, it's split 70-30. And then whenever the entity gets liquidated, what happens there? Okay, we're going to get into our waterfalls here in a second. All right, sensitivity analysis. I mentioned in our screening process that you needed to look to make sure there's a sensitivity analysis, but we didn't go much deeper than that. Okay, it's because sensitivity analysis is a bigger beast. Okay, a sensitivity analysis is just a methodology that takes into account several factors that might impact the investment's returns. Okay, and then it's generally on a grid, so you can see when each lever gets moved, what is the potential return and how it might affect your profits. Here's the thing, sensitivity analysis can be manipulated. Okay, so we want to make sure that we're working with amazing operators that are not going to manipulate the sensitivity analysis. So how do you know if a sensitivity analysis is potentially manipulated? Well, we want to make sure when we look at the pro forma, that forward-looking projection, okay, if we go back to our webinar, our bootcamp that we did on offering memorandums, we looked at a pro forma, forward-looking projection on what was going to happen to an asset. We said we wanted to make sure that that forward-looking projection had conservative rent increases, conservative vacancy estimates, a conservative business plan as far as timelines, lease up, construction. They weren't super aggressive. Okay. If all of these top 3 metrics are conservative, our stress test analysis is our sensitivity analysis is going to be something that we can we can believe in. Now, if they've gotten really aggressive with rent increases, or they underestimated vacancy, or if they're taking they're saying they can lease up 100 units in 3 months, really aggressive lease up plan, that's going to skew the sensitivity analysis, okay, make it look better when it might not be. Okay, so what does the sensitivity analysis look at? Well, it's going to take a look at the return, okay, which is going to be a formulation of like the net operating income. You're going to divide it by the cap rate. Okay, that's going to give you a valuation, and then you're going to get our waterfall, and then you're going to get a projection of IRR. Most operators, what they're going to do is they're going to move the cap rate around, which is going to, and then they're going to move the return distribution around at that particular cap rate. And then they're going to, figure out with these 2 matrices being moved, what is now the IRR and the equity multiple. Okay. So what I tell investors, when you look at a sensitivity analysis, make sure that the operator isn't saying, hey, we're coming in at a 5% cap rate and we believe that it's going to go down to a 4% cap rate. Okay. The reason is who thinks the market's going to get better, right? What I would rather look at is we're entering at a 4% cap rate, and that operator has looked what happens when the cap rate expands and goes up, the market gets worse, and that they know what the impact will be to the property. Okay, so we always want to make sure that our entrance cap rate is either at the bottom or like really close to the bottom, and that the operator is looking at the cap rate expanding in the market. Okay, what I tell investors then is, are you happy Are you okay with these particular returns in the expanded cap rate model? All right, so we talked about the big three: capital preservation, cash flow, equity growth. All right. Diversification, that is something that I talk about a lot. You can jump over to the Passive Investing Made Simple Masterclass episodes. We've been talking a lot about the diversification, making sure that you have assets in each layer of the capital stack, not just all in common equity. Okay. But now we get to get into tax benefits, which is another reason why a lot of investors get into passive real estate investments, okay, is they get in here because of the tax benefits. They want to have depreciation. They want to take advantage of accelerated depreciation. So fast forwarding that depreciation to the first 5 years of the hold. They want to take advantage of tax credits like bonus depreciation. Okay. Now, the first two are accounting methodologies. That's not going to go away, not with any administration change. I mean, there might be some little bit of rule change every now and then, but depreciation's pretty much been in play for decades. What has been changing is the bonus depreciation, the tax incentive, okay? That can then change. So depreciation, accelerated depreciation, those are things that operators should be taking into account. They should be doing that on every multifamily self-storage deal, everywhere they can. The bonus depreciation is going to be more about what's happening in government policy. So we get less control on that. The other piece that you can control as an investor is, are you investing in a deal that is going to share the depreciation pro rata? Meaning for whatever percentage of the entity ownership that you own, you're going to get that percentage of the tax benefits flowing through to you. Or are you going to get more or less? Okay, we want to make sure at minimum we're getting pro rata sharing in those tax benefits. Okay, you don't want to get less than that. And then 1031 exchanges, okay? 1031 exchanges, that's a way to kind of kick our tax liability down the road through playing a little bit of monopoly and trading up and keeping all of our depreciation, recapture, and capital gains tax-free. You make sure to listen to my other master classes on depreciation because that may not be something that you always want to participate in. But that is a way in order you get the same tax benefits on passive real estate as you would get if you were holding a single family rental yourself. All right, smart use of leverage. Okay, if we're underwriting a deal, I want to make sure that I understand who the lender is on that project. Are they a public lender or are they a private lender? Now, you might run across the deal where there's no lender, that the operator is buying the property all in cash. I say, no, okay? Unless there's a clear track record. It's just, for me, I have it as a big X on my due diligence checklist. If somebody's buying a property all in cash and they want me to hand over the cash to improve the property, it is so easy for them to hide that cash and run away with it. However, if there's a lender involved, there's fewer areas for them to hide, okay? Now, it's not to say that things still can't go wrong, just fewer areas for that operator to hide. So I want to look at the biggest part of the capital stack. Who's the senior debt position? Okay, who's holding that? Then I want to look at the other layers of the capital stack. Okay, how many other loan layers are coming in? What do they total up to? Okay, I want to make sure that there's 75, ideally 65 or less loan to value on the property. I want to look at, is that loan that's being taken out, is it a recourse loan or a non-recourse loan? There's pros and cons to both. Is it a fixed rate loan, say like a Fannie Mae loan, Freddie Mac loan, okay, where the rate is fixed, say for 25 or 30 years? Or is it just fixed for a period of time and that the operator needs to purchase rate caps to artificially fix the rate for longer? Are extensions in place? How many? Okay, what needs to happen in order for those extensions to the loan to happen? Is the loan an interest-only loan? Is it for the term of the hold, or is it only for a short period of time? I want to make sure that I'm looking at all these variables to make sure that the loan is putting the business plan in the best position to achieve success. Okay, I'm not looking for the loan itself to mitigate all risk. I'm looking for the loan to put the business plan in the best position for success and there to be a little bit of built-in flexibility, okay, in case there's a rough market, in case construction goes a little bit longer. I want to see flexibility. All right. This is what a capital stack looks like. I mentioned a capital stack. When we're talking in terms of lending, our senior debt, our bank debt is probably going to be the one stepping into that 60 to 65% levered position. Maybe they're able to take out a mezzanine debt position on top of that. What I want to be careful of is that an operator isn't taking out 75% loan to value in debt and then inserting another preferred equity layer of 10 to 15% on top of that. That means we're getting super risky up at the upper layers of the capital stack. All right, the waterfall. Who gets paid what and when? All right. So it's important to understand what the waterfall is and where to find the waterfall. The waterfall might be alluded to in the offering memorandum, but it is for certain going to be in the private placement memorandum. You want to double check that the waterfall is outlined in the private placement memorandum before you sign, okay? And you want to understand, where do you as the LP sit? You're probably sitting behind all of the debt, okay? And you're in a profit sharing position with all the distributable cash flow after all expenses, fees, debts, and reserves have been paid. Now, this is important, okay? We took a look at this earlier. We've got our capital stack here. We have our partnership structure, okay? So we've got the capital stack up here, the different layers of the money. But who gets paid what and when? Well, when an asset sells, we already know here in the partnership structure, the investor was getting a 7% preferred return, and then all cash flow after that was being split 70-30. But when the asset sells, what happens? In this case, the debt gets satisfied first, okay? All expenses and fees and everything will get satisfied second. And then anything left over, anything that's actually distributable cash flow, will be split 70% to the limited partner investor until the limited partner gets a 13% internal rate of return. And then it'll be 50-50 after, okay? So really, this puts the general partner in the upper tiers. I'm going to go back here of the capital stack. Okay, they're getting, if the limited partners here, the general partners up here. They're working hard to get that additional split after the 13% IRR. All right. So wealth pillar number 6, deal vetting, inflation hedging. Now, this kind of alludes back to what kind of debt we're putting on the property. So if you can lock in debt in today's dollars and allow the devaluation of the dollar to erode the debt, awesome, okay? But there's other ways to kind of hedge inflation, okay? It doesn't just have to be locking in the loan at a fixed rate for a long period of time and then paying down the loan. You can also achieve an artificial inflation hedge, or you can get inflation hedging by also being able to increase the rents and adjusting the cost of expenses as they pass through, to the tenant, so if taxes go up on a property or insurance goes up on the property, then you should be able to raise the rents on the property to account for that additional raise in expenses. All right, last piece here that we want to cover in our deal vetting is understanding the operator, okay? We want to make sure we're investing only with experts, right? We alluded to earlier in our, kind of brief conversation about the 7 red flags that we want to make sure we're investing with an operator that has the background, track record, and experience, that there's at least 2 managing partners that are ideally unrelated. So if they suffer some unfortunate event in their family, they're still in a managing partner to keep the business running. But once we kind of have those 8 red flags chosen, okay, or ticked off that they're not there, now how do we dig deeper on the operator? Well, before we invest, we want to make sure that there's no material business changes, okay? We also want to make sure that we're talking to referrals in order to get a current snapshot of the business. Now, obviously, if you talk to an operator and the operator goes, here are my top 3 referrals, they're going to pair you with somebody that loves them. When you talk to the referral, ask the question, who else can I talk to about this operator, right? And you can dig deeper that way. Also, you can go onto the Security and Exchange Commission's website and look up the Edgar filings for past deals. Make sure the operator actually files their documentation. You can also go to a website called formsd.com to get that information. You can also go on to Google or your browser of choice and do a quick web search. So type in the operator's name, company, and legal, lawsuit, legal filing, right? Scam even. You can just put that after their name and see what pulls up, okay? To sift through the information, figure out what's real, what's not. But that's a good way to surface some potentially negative reviews on an operator. All right, guys, we have covered a lot of information. I encourage you to rewind, embody this webinar, okay? This webinar is going to give you like 95% of those tips in order for you to generate your own due diligence checklist. So this is kind of like a little bit of snapshot of mine. Seriously, when I look at a deal, I'm like, grading it, either ideal, good, or I need to ask questions on so many different points. All right, I might take some small notes there. I want to find deals that are mostly ideal, maybe have a few boxes that are good, and then, only a couple boxes where I need to ask some more questions for a follow-up. But make sure you have a repeatable checklist that you can work deal to deal that actually works like a checklist. Okay, that way you're not missing steps along the way. Okay, any question that you have, you should just go back to the operator and ask it. That's what they're there for. They expect to get questions on their deals. If there's an investor webinar, make sure you're reviewing the investor webinar before you ask questions, because oftentimes they've already gotten a series of questions and then they put out their webinar about a few days after their deal's been released, and that webinar will answer almost all your questions for you. But again, feel free, always reach out to the operator for an answer. But most importantly, make sure that you are making a decision. All right. You don't want to, sit on a deal for like 3 weeks and then come back to it and go, oh, now I want to invest, because it might be closed. So make sure you have a good process that you can work in an hour or 2 in order to get to an investment decision. All right. Here's also my last piece of advice. As market changes, the market is volatile right now. Right now, we talked a lot about debt being king in this market, but equity deals will eventually come back online. The thing is, as the markets change, so should your expectations on which layer of the capital stack you need to be investing in and what type of returns would be appropriate for that part of the market cycle. All right, guys, your action plan here, make sure that you are creating alignment by defining your goals, your risk, your timeline, your diversification strategy. You've got that 10-minute deal screening process in place. Maybe you just keep it on a short little sticky note on your computer. And then you create your deal vetting spreadsheet. Okay, make it simple, something that you just like mine, something you can take some quick little notes. Give it a quick little grade, and then you can get your questions answered. Guys, it has been amazing hanging out with you today. If you have further questions, be sure to reach out to me at whitney@passiveinvesting.com. If you're watching this on YouTube, join us at passiveinvestingwithwhitney.com, where you can get priority access to our open deals, one-on-one call to discuss your investing goals and how we can help you achieve those, as well as additional masterclasses like these.